Hey guys, welcome back to another episode. In this video we will be going through our very simple yet profitable RSI and stochastic oscillator hidden divergence trading strategy. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. And don't forget to share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. This is the most effective combination of RSI, stochastic oscillator, and smoothed HEIKEN ASHI indicator. In this video I'll show you one of the most profitable trading strategies every trader should know. The indicators needed for this strategy are 200 smoothed HEIKEN ASHI, RSI 5, and stochastic oscillator 5. The first thing is very simple. The 200 smoothed HEIKEN ASHI just acts as a basic trend filter. So you can only take long positions when price is above the 200 smoothed HEIKEN ASHI. And you can only take short positions when price is below the 200 smoothed HEIKEN ASHI. The HEIKEN ASHI smoothed indicator is a modified version of the regular HEIKEN ASHI candlestick charts. A product of Japan, the HEIKEN ASHI charts are ancient and were brought to the West only a few decades ago. The HEIKEN ASHI is a type of chart used to analyze the price of a security. Unlike the regular candlestick charts, the HEIKEN ASHI candlesticks are used to understand the price trends. This is done due to the way the price is calculated and displayed on the chart. Unlike the regular candlestick chart which shows the open, high, low and close of the price during a session, the HEIKEN ASHI chart takes a different view. The open, high, low and close on the HEIKEN ASHI chart is calculated as follows. Close. This is nothing but the average price of the session. Open. This is the average of the open and closing prices and the closing price of the previous session. High. Maximum value of the high, open, and close. Low. Minimum value of the low, open, and close. What you can see from the calculation is that the HEIKEN ASHI price chart gives attention to both the high and the low as well as the closing prices. This leads to a different perspective on how the price is displayed on the chart. The HEIKEN ASHI chart can be applied to any time frame and to any market like stock, Forex, commodities, and cryptocurrencies. It behaves the same way as you would expect a regular candlestick chart to work. The differences between regular HEIKEN ASHI and the smoothed HEIKEN ASHI chart. You might come across claims that the HEIKEN ASHI smoothed indicator is a better indicator type compared to the regular HEIKEN ASHI indicators. While you can typically use the regular HEIKEN ASHI chart all by itself, the HEIKEN ASHI smoothed indicator is added as an overlay on the regular HEIKEN ASHI candlestick chart. By doing so, traders believe that this will give a better perspective of the markets. When price is trading above the HEIKEN ASHI smoothed indicator, it is said to be bullish. And when price trades below the HEIKEN ASHI smoothed indicator, it is said to be bearish. But the main difference between the regular HEIKEN ASHI indicator and the HEIKEN ASHI smoothed indicator is that the second type of indicator plots the HEIKEN ASHI candlesticks as a moving average. Thus, you can see both the regular candlestick or bar chart alongside the HEIKEN ASHI smoothed indicator. Parameters. The settings for the smoothed HEIKEN ASHI indicator is very simple. You can set the values of the two moving averages that are used. The moving average method means the type of moving average you want to use. Moving average method 1. Choose the moving average type to use in the calculation. Period 1. The number of bars to use in the first moving average calculation. Moving average method 2. Choose the moving average type to use in the calculation. Period 2. The number of bars to use in the second moving average calculation. You can also identify the colors of the candles. Up bullish candle. Blue. Down bearish candle. Red. One of the key characteristics of the HEIKEN ASHI smoothed candlestick is that usually both in an uptrend or downtrend the candles have very little, but in most cases no lower shadows, while it poses extreme upward or downward. Interpretation. The general rule of thumb is that the markets are in an uptrend when the smoothed HEIKEN ASHI indicator is bullish or blue. and the markets are in a downtrend when the smoothed Heiken Ashi indicator is bearish or red. Buy and sell signals are generated based on this rather simple observation. You can see that the smoothed Heiken Ashi indicator shows the rising and falling trends with relative ease. How to use the Heiken Ashi smoothed indicator. One of the major rules of using this indicator is in determining the trends in the markets. It is a widely accepted principle that the trends change when you see two or more Heiken Ashi smoothed candlestick in the opposite direction or color. This is where traders either prepare to take an entry in the direction of the trend or the color, or they can use this to adjust their stops. Bullish and bearish signals are generated when the moving averages mark a golden cross, or when the short-term moving average cutting across the long-term moving average to the upside, and the death cross, or when the short-term moving average cutting across the long-term moving average to the downside. But as with any trading strategy, using just one indicator will not give you the market perspective. This is the same case with the Heiken Ashi smoothed indicator as well. You will probably need to use other indicators such as RSI and stochastic oscillator. In this strategy, the RSI is going to be used for spotting the divergences. I'm going to go into some examples and show you how to do that in just a sec. And then the stochastic is the entry indicator, so it's going to give you the actual entry signals after you have found the divergences with the RSI and identified the trend with the 200 smoothed Heiken Ashi. And now, let's go in and show a few examples. So first thing, we're going to spot some divergences before we can ever think about taking any entry with the stochastic oscillator. So let's look. We have higher lows on price, so we're going to be comparing the lows on the RSI to see if we get any hidden divergence. So, low here makes this low. Low here makes this low on RSI, then we get this higher low price, but a lower low on the RSI this time. That is a divergence. And you can draw it in, so you can just be sure of yourself that you've actually spotted a divergence. Higher low on price, lower low on RSI. So once you've spotted this bullish divergence, then you know that you're looking for the next cross up on the stochastic oscillator to take a long entry. 200 smoothed Heiken Ashi is also agreeing here, which you need to make sure of price is above the 200 smoothed Heiken Ashi, and we have a cross up on the stochastic oscillator right here. So this candle is the buy entry candle, and you're going to take your buy on the candle. Stop loss goes just below that nearest swing low, and you're going to target 3 times the risk for the profit target. And now, let's go to another examples. We have higher lows on price, so we're going to be comparing the lows on the RSI to see if we get any hidden divergence. So, low here makes this low. Low here makes this low on RSI. Then we get this higher low price, but a lower low on the RSI this time. That's a hidden divergence and you can draw it in. So you can just be sure of yourself that you've actually spotted hidden divergence. Higher low on price, lower low on RSI. Once you've spotted this hidden bullish divergence, then you know that you're looking for the next cross up on the stochastic oscillator to take a long entry. 200 smoothed Heiken Ashi is also agreeing here, which you need to make sure of price is above the 200 smoothed Heiken Ashi, and we have a cross up on the stochastic oscillator right here. So this candle is the buy entry candle. And you're going to take your buy on this candle. Stop loss goes just below that nearest swing low, and you're going to target 2 or 3 times the risk for the profit target. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of RSI and stochastic oscillator hidden divergence trading to fully understand this wonderful strategy and to make the most out of it. So, this strategy is pretty simple. You just need to make sure that you know how to identify hidden divergence, hidden bearish and hidden bullish divergences for shorting and longing. It's a very important part of the strategy, so make sure that you know how to identify hidden divergence if you're going to attempt to trade with this strategy. It's pretty simple. Once you do master this strategy, it's highly profitable, and you can make adjustments to this to make it even better. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.